We're going to discuss the biggest backtesting mistakes that you can make when you're doing your algorithmic programming code. So backtesting is a testing trading strategy that applies historical data. It serves as a research tool for traders and analysis experts to stress test their current strategies, find new strategies, to find which factors contribute the most to the trading success. Most backtesting is done through code using libraries from languages like Python and R. And hence, you can pretty much backtest anything if you have the coding skills to create it. There are also some no-code or low-code backtesting solutions like TradeStation or MultiCharts, but they tend not to be flexible enough for professionals. An example of backtesting would be to download a decade's worth of market data, let's say 2007 to 2017, and test a trading strategy that you are curious about. You need to be able to put that strategy into a strict quantitative format, like buy when the 50-day moving average crosses above the 200-day moving average, instead of buying a bull flag. After the computer is done running the test, you get results like an equity curve, the list of trades, and some metrics like the Sharpe ratio and max drawdown. Backtesting often feels like complete magic. You download a bunch of market data, run some parameters against it, tweak them a little bit until the test shows a smooth equity curve, and presto, you have a profitable trading system that will print money. It can seem like the only barriers are learning to code and understanding which indicators and parameters will yield the best results. But doing that is simply data mining, and using this method of backtesting has little utility because your test will have no predictive power. It represents a mistake even the most sophisticated researchers repeatedly make, mistaking correlation for causation. I'll give an example below. You've run thousands of tests using machine learning to find the most profitable trading system. The best test shows that the optimal strategy is to buy XYZ stock at 10:53 a.m. on a Tuesday, when on the previous day the price advanced at least 1.04% and the RSI is at 38 or more. Obviously, this means nothing. If I told you this was my trading system, you'd laugh at me for having such a pointless system that does not exploit any real imbalances in the market. All this test did is find the perfect parameters to fit into that exact historical data. While data mining when backtesting is really this blatantly pointless, you have to constantly check every bias you introduce into a test. And here are a few of the most common mistakes that are crucial to avoid if you do not want to incinerate money when trading with backtested strategies. The first is the look-ahead bias. It's 2021 and the market has more or less gone straight up for the last decade, save for a huge crash in 2020. Knowing this, you can go create a backtest against our historical data to reflect. For example, you might say buy the S&P 500 on 5 times margin, but sell when the price drops 5% or more in one day. You know that this system will kill it because it avoids most of the 2020 market crash while reaping huge gains from the rest of the bull market. A test like this will look really nice and can make you wish you only had the system in 2010 because you'd be rich right now. But you're basically cheating. It's like watching a replay of a football game and then concluding that the best way to win that game was to run the ball on 4th and goal because passing the ball failed. You're just looking at what actually happened in the past and pretending like you knew the right answer all along. It might be a fun exercise, but it won't have any future predictive power. Of course, this look-ahead bias creeps into our backtest in more subtle ways. Using the same bull market example, momentum strategies on growth stocks have worked excellently. And traders who use those strategies over the last decade won big. This can easily lead you to believe that momentum strategies are inherently superior, and you tailor your entire style to what is working in recent backtest. The next example here is overfitting or over-optimization. The mistake goes hand in hand with the look-ahead bias. It's the act of continually iterating on a backtest and using previous backtest results to inform the new ones. While this can be a valid practice used by many professionals, it's very easy to get wrong. Let's say you're using a simple RSI mean reversion strategy. You buy when RSI is below 20 and close the position when RSI is above 60. The backtest results look pretty good, but when you analyze a few individual trades, you find that the biggest losers result in you buying too early. In other words, you think a lower RSI value may result in a better test. So you try testing buying below 15 and selling above 60. The test looks better, but again, when analyzing individual trades, you find that some of your winning trades go on runs, so you decide to extend your holding period and close trades when RSI is above 70. This process might feel like a productive process of slowly optimizing your trading strategy to get the best results. But in reality, you're really just p-hacking. You're throwing several observations on one set of data until a test shows the desired result. This is a problem in many scientific fields and is the reason that most academic studies are not replicable. Let's simplify with a real-life example here. You love basketball and you want to show off your skills. You record yourself throwing 10 free throws over and over until you finally hit 10 in a row. Of course, that's a video you upload to YouTube. You're simply performing the same test over and over until you get the result you want. Of course, that's not representative of your actual basketball skills. One way to mitigate this bias is by using out-of-sample data. This is when you test and optimize your data on, say, market data from 2007 to 2012. But then once you're done optimizing it, you see if you can repeat similar performance on data that your model has not seen, like 2013 to 2018. It's kind of like endlessly trying to get 10 free throws in a row. Then once you've done it, you try out your new tactics completely fresh to see if you can repeat the results. If you hit 4 out of 10, your previous test was probably an anomaly. Of course, there are legitimate methods of optimizing backtest results. Many heavily utilized walk-forward optimization strategies which test the strategy on unseen data, preventing you from the snooping bias that we've labored so heavily here in this discussion. There are many professionals that don't use optimization methods at all and instead stick with very rough backtests that test the core ideal rather than specific parameters. And this is where the next one comes in, and that's treating backtesting as an engineering problem. The primary obstacle to start backtesting is learning to code and understanding how to handle financial data. As a result, a huge number of programmers fear that you can test trading strategies by writing some Python and are rightly intrigued. But being programmers and not experienced traders, many suffer from treating it as an engineering problem, meaning they focus more on shiny objects like machine learning, high-level math, and cool tools rather than figuring out trading strategies that have a logical grounding. By no means am I saying that machine learning or math is not important, not at all. But they're just tools. If you don't have a specific reason to utilize them, it's no different than a new trader trying every combination of technical indicators on TradeStation backtest. With modern computer hardware, it's a very trivial task to run thousands of simulations against financial data. You can come up with all kinds of crazy results, and you might find that buying oil stocks in January after the price of gold has declined 3 days in a row is a strategy with 100% win rate. But think about it, why would that work in the real world going forward? What are you exploiting, or what service are you providing to the market by making these trades? The next thing is neglecting transaction cost. Over time, you'll find that transaction costs, while they've declined significantly over the last 2 decades, will eat up a big chunk of your profits. But it really depends on the type of strategy that you're employing. If you're a hyper-aggressive day trader who trades high-flying stocks, transaction costs eat up a huge portion of your profits. But the position trader who holds trades in highly liquid future contracts for a few weeks at a time will be less affected by them. And liquid stocks, which is this one hidden transaction cost, is the difficulty of getting filled in a liquid stock. For example, let's say you're employing a share class arbitrage strategy. It's very easy to fool yourself with this type of trade because when you don't account for the transaction cost, it looks like a high Sharpe ratio strategy. The next thing is, now how do I learn to backtest trading strategies? There's yet to be a streamlined platform like Code Academy for learning to backtest trading strategies that I know of. And most tutorials are tailored to specific library or source of data. Many examples rely on Zipline, the backtesting library for Python that now defunct Quantopian developed, but the company stopped maintaining the library after they were acquired by Robinhood. So as of now, since there's no official path to learn backtesting, your learning path really depends on your level of competency with programming. If you're brand new, you're best off starting with Python because it's the most popular language for manipulating financial data, and it's pretty easy to get started with. DataCamp also has some decent courses that teach you to mess around with financial data, but it's not very trading focused. And a decent book with some good trading is Andreas Klenau's Trading Evolved. Yes, it utilizes the Zipline library, which is no longer maintained, but if you're brand new, the most important aspect is understanding how to manipulate financial data. And once you've learned the essential libraries for this, NumPy and Pandas, it becomes a lot easier to go and piece together your own algorithms with Stack Overflow and related websites. And the bottom line here is it's way too easy to be fooled by a backtest. Sophisticated high net worth investors are frequently fooled into investing into questionable hedge funds based on fancy backtest and simulations. It's healthy to be cynical when you see any backtest result, but don't be a defeatist. There's a reason that backtesting is a vital tool in the professional trader toolbox. The problem is not with backtesting, it's with the misunderstanding that a successful backtest proves anything. It's a research tool, and when approached that way, it's rewarding.